Right now in Washington, D.C., it's the NABE Policy Conference. That's the National Association for Business Economics. Yahoo Finance's Brian Cheung joins us now from D.C., and he is with Grant Thornton's chief economist, Diane Swonk. Brian, over to you.
Hi there. Yeah, so here in Washington, D.C., there have been a number of topics that we've been talking about specifically on the economy. Obviously, a noisy week of data as far as GDP numbers. I'm standing here with Diane Swonk, chief economist at Grant Thornton. And GDP numbers came in for Q4 at an annualized rate of 2.6 yesterday. We do have some consumption numbers in today, though. So let's talk a little bit more about that.
So the personal income and consumption numbers for the month of December are finally out. Everything's delayed because of the government shutdown. And they had a partial look at January, just the income data, not anything else. But we saw in December was confirmed, unfortunately, those ugly retail sales reports, and that's that consumers actually pulled back on everything, including services. The declines were across the board, even though income surged. Part of the surge in income was actually farm subsidies being paid out to farmers, being compensated for the retaliation that China has taken, particularly on soybean farmers. In January, income fell again, and it fell because those farm subsidies didn't show up because the government shutdown was going on. It also fell because dividend and interest income fell. So, and we even saw a little weakness in manufacturing income. So, these are noisy data, and there was a lot of strength earlier in the quarter of the fourth quarter, and it came out of nice solid gains. This doesn't change our view of what happened in the fourth quarter, but we're going to start the year on a weak note.
So on that note, it sounds like a lot of those wins that we've seen in that consumption data is kind of government-led. When you think about the government shutdown, the farm subsidies, obviously something that you talk about as well. As we head into 2019, what other kind of political risks do you see facing the U.S. economy as far as that growth? Do you think we can get 3% as the president has said?
We're not going to get 3% this year. And part of that is because the tax cuts are wearing off. So it gave us a nice boost in incomes, and people actually spent their tax cuts and more because they got with drawdown and withholding. So they actually were taking home more pay and not realizing that they were spending their tax cuts, and sometimes the refunds are coming up a bit short now because they've already spent it, but they thought their refunds were going to be there. So there's that issue. So that's playing out. But we also have some headwinds starting to emerge. And, it's not just tariffs and trade war. It's just this uncertainty. And I deal with a lot of clients in the middle market, and they're sort of sideswiped by all these things. And they're so uncertain about the global economy, and they're so linked to the global economy that they're hesitating. When you have hesitation, you don't have investment, you don't have a foundation for growth. It's not collapsing, it's just slower growth. We're still generating lots of employment numbers, which is terrific. And much of the income gains are in the lowest level of wage earners, and so they're finally getting money. What's been unique about this particular cycle is even as those low-wage workers start to get a little money in their pocket, and of course they spend everything they get, which is great for the economy, but it's not rippling up. It used to ripple up. So if a low-wage person got a raise, their manager got a raise.
And when we talk about wages, we also think about what the Fed has said about inflation. They've said that a lot of these pressures are muted for the time being. As far as wage growth, is that something you're watching for pretty closely, especially as the Fed acknowledges that we should see slower growth across the board in 2019?
Yes, and the Fed believes that as well. And the Fed has been humbled by the fact that they thought once we hit 3% wage growth, which is we're above that now, consistently, we would just automatically get 2% inflation. We'd be at their target, and then the whole world would be perfect. And that didn't happen. The good news is that, because we're not getting more inflation, the Fed can step to the sidelines, and inflation is a little tepid at the moment, but it's important because as the Fed steps to the sidelines, they can allow the economy to have more room to run. We're in a marathon of a race, and they want more people joining that race, and we're seeing that come in. In fact, the largest increase in participation has been among young women, millennial women coming into the labor force en masse, and that's really important. The biggest increases in participation have been among the most educated of those women, but it's across the board. And it also is a lot of women that have our Hispanic origin are driving it, and that's where we had the influx in millennials in the 1980s.
Now, broadly on the point of the Fed, we've heard Vice Chair Clarida speak here yesterday reiterating patience. We heard Chair Powell on Capitol Hill saying that, they see crosswinds ahead, but that they still see the cross currents ahead, but that the economy still looks okay. Seems like rate hike pause for the time being, but do you still expect something by the end of 2019, maybe 1 or 2 rate hikes?
I expect no rate hikes this year. Now, it'll be interesting. I'm interviewing Raphael Bostic later today, and we'll get his view. He was at 1 rate hike. We'll see if he's still there. I think we'll probably see it move down from 2 to 1 when they redo their forecast, but that's not necessarily what they're absolutely committed to doing. It's just what they think they might do, and I think they're going to be sidelined the rest of the year. The most likely time you get a rate hike is around September, and when I was interviewing Senator Warner, who's on the Budget Committee yesterday, I asked him about the prospects of having fiscal year 2020 budget done. And he couldn't even, his response was, this is going to be another crisis. September is when that happens. And so if we're in a budget crisis again in September, and we could fall off a fiscal cliff, fiscal year 2020 starts October 1st. And that is another drag on growth, but also it's another reason that the Fed may be sidelined the entire year.
All right. Well, definitely something to watch there. That's it for us here in D.C. with, again, Diane Swonk, Chief Economist at Grant Thornton. We'll send it back to you in New York.
All right. Thanks, Brian.